Hey, welcome back. I'm Logan. We're doing a month in review for September. We wanted to review this month because it's been kind of rough. I mean, S&P 500 is down about 4%. The NASDAQ's down about 5%. So what's going on, even though it's been kind of really a good year overall?
Yeah, I mean, if you've read any of our pieces, we put one out just last night. I won't put those missives out too much now that we've kind of changed our structure a little bit. Hope you've been enjoying the weekly reviews. But the market's pulled back the month of September. It really started in August. You know, was not a very good month either. Summer doldrums. There's some seasonality there. On balance for the year, markets as a whole have still done fairly well. S&P 500 at the time of taping this is around 12% or so for the year. NASDAQ 100, 4 or 5 or something like that for the year. Well off its highs. I mean, at one point it was over 30, but still a relatively good year. Now, that being said, it's been very narrow. You'll hear this a lot. It's been very narrow to a few large cap technology stocks, which means a diversified portfolio, anything from international, emerging, small caps, mid caps, even gold, has really been struggling. Now, our view is for the market to sustain itself, that's going to need to expand. That breadth is going to need to widen. We're going to need to see other stocks participate. We'll see what happens. But no, on balance, it's been a pretty good year, and we don't view this necessarily as a warning shot that, all things are going to come unglued, but more or less a pullback that provides some opportunity.
Okay, so what is moving the markets right now as we go into the end of the year?
Yeah, so what's been moving the markets really, I would say there's kind of three things that have been mostly moving the markets. The first is this combination of the Fed, interest rates, and inflation. That's the biggest component. Inflation, by all accounts, has come down considerably. CPI, much, much less than just a year ago. However, there's some sticky parts to that. One is employment, continues to be very sticky. Energy has been on the rise. That was really the fly in the ointment. Last employment or last CPI report, was the uptick in energy. However, by all accounts, everything else is coming down. Now, doesn't mean prices are coming down. We've talked about this, right? It just means the rate that they're rising has slowed.
Yeah, still increasing, just increasing at a slower.
Yeah, which is what we need. We don't want to go the other way per se because that's deflationary. Another subject matter altogether. Now, in this whole thing, what's been really driving the markets, particularly in the month of September, has been the Fed's message, Jerome Powell coming out and basically taking this higher for longer stance, removing language about a soft landing, pretty much throwing the economy under the bus, if you will, and saying, no, we're going to get to our 2% target. What's the problem with that is that if you're an investor or anybody really watching the economic data is coming down very, very quickly. So ultimately, there's this combination of, is the Fed really going to continue to raise rates, or are they too watching the economic backdrop? Our view is that the Fed is talking tough, which they probably should do. They don't want to see inflation ramp again very quickly. But ultimately, our view, at least right now with the data that we have, is that rates are done. They're not going to continue to raise rates. So that's, again, a reason why we like the pullback in the market. We do believe it's an opportunity. I would say the second thing moving the market to a subtle degree, we don't think it's very market moving, and that's counterintuitive, but it is something that investors are concerned with, and that is, everybody seems to be striking, right? So the Hollywood writers' strike just came to an end. UAW is still on strike, and Las Vegas hotel, food and beverage, bars, etc., have just voted to strike. So there's this movement out there to have these unions fight for higher wages. Now, as I wrote in the piece just a minute ago, or at the bottom of this video, ultimately, the end result of that, if you know anything about supply and demand, is job loss. Mm-hmm. What happens is, as those wages go up, prices are pushed on to consumers, the consumer backs away, inventories build, prices go down, people are laid off.
Right.
That's an economic function that's happened since the test of time. It will continue to transpire. It's not all that market moving. Nobody's really on edge, but it is something that people are watching. I would say the third and the final piece, the bond market seems to be watching more than the stock market right now, is the government shutdown. More than likely at the conclusion of today, I think it's a series of bills would need to be passed in order for Congress to pass a budget. It's not going to happen. At least I understand. Our sources say that's not going to happen. And then ultimately, the government will be shut down effective midnight on Sunday, going into October. And why isn't that really rattling markets? Because it's happened 20 times in the last 4 decades. The last one was a 35-day shutdown in 2018, 2019. Eventually, it started to wreak havoc on the market. I will tell you this. It started to really cause problems because it impacted the bond market and interest rates. A lot of things come back to interest rates. So the bond market seems to be, kind of warning of this a little bit more than the equity market. We'll see what happens. From our view, and a lot of investors, the belief is we know how this plays out, a lot of political jockeying, a lot of back and forth, and then we ultimately raise the debt ceiling. We kick the can down the road, whether it's right or not, and we deal with it later. At some point, we're going to have to deal with this. I don't know when that day comes, but at some point, we're going to have to deal with this. I don't think that's 2023. We'll see.
Yeah, so is there anything else that we need to be aware of or watching for over the next few months into the end of the year and kind of closing out?
Those are the biggies. I mean, economic data, we're in an environment now where economic data is critical. Markets are up today, at least at the time of this taping, because we got weaker than expected economic news.
Yeah, we're still living in this bizarro world where
we are.
Bad news is good news.
Yeah, and what that means is as economic news is soft, what it's really saying is inflation is soft. If inflation is soft, the Fed doesn't necessarily have to raise rates or keep them where they are. They might even eventually need to be able to lower that, and the market, the stock market, likes that. So we are in this little bizarro world, if you will. However, that said, the world we live in with the markets, we're looking at interest rates. We're looking at what the Fed's doing, what the inflation rate is doing. And so ultimately, if we are in a trajectory where eventually those rates will be coming back down, even if it's not the Fed yet, so even if the market predicts that and the Fed doesn't do anything yet, that ironically has traditionally been good for stocks. So, to summarize, it's been a difficult summer. I don't believe October will, just miraculously be great. I do think we'll have more volatility, but I am looking for a positive finish to the year, in our opinion. And the reason is because of those factors. The inflation rate is slowing considerably. I don't believe the Fed will have to talk as tough. And ironically, the economy is softening. And as the economy softens, the market looks ahead and says, well, that means the Fed's going to have to do something. So when we get this weakness in the market, and a lot of people out there start to become concerned, we start to look for bargains. If there's money on the sidelines, we look to put that to work. We're looking at our portfolios actively, making sure is there any area we need to shift or move to see, if there's better opportunity, and then end of the year if there's any rebalancing, et cetera. So should be a fascinating Q4. There'll probably be a lot to talk about. Definitely more videos to come.
Yeah, definitely more videos to come. We'll be bringing these to you more often. Make sure you're listening and looking out for the different materials that we're writing as well. We'll be in touch soon. Have a good one.